There's no sign of identity theft slowing down. And why should it? More than $29 billion were stolen from identity theft victims last year alone. To cybercriminals, it's a success story. To the rest of us, it's a wake-up call. Your personal info is in more places now than ever. And all that exposure can make it dangerously easy to steal your identity. LifeLock makes it easy to help protect yourself by monitoring your identity and alerting you to threats you could miss on your own. And if you do become a victim of identity theft, a U.S.-based LifeLock restoration specialist will be dedicated to your case and will work to fix it. Don't wait to get LifeLock identity theft protection. Join now and save up to 25% off your first year. Go to lifelock.com/ACAST. That's lifelock.com/ACAST to save 25% your first year. LifeLock. Identity theft protection starts here.
Hi, and welcome back to Shares for Beginners, where we have a special treat with not one, but 4 guests to help guide you in navigating your investments and your future. This event was held in the offices of our friends at ShareSite on September 24, 2019. ShareSite is a fabulous portfolio tracking tool. Try out their 7-day free trial, and if you do decide to purchase a plan, go to sharesite.com/shares for beginners, where you can pick up 2 free months on your subscription. This event was hosted in conjunction with Finimize. Check them out and their daily updates that help you to focus on what's important in finance news. I was the moderator. There were some great insights and passionately held convictions from the panel. We're going to get on to tonight's subject, which is things to avoid in investing, or common mistakes that all investors make. Now, I feel like the mosquito at the nudist colony. Where do I start? There are so many mistakes that we can talk about. I'll introduce the panel first. To my immediate right, we've got Claude Walker. Claude is an investor who looks for the best opportunities at the small end of the ASX. He's the founder of Ethical Equities, and he looks for profitable, ethical businesses suitable for investing in. Next to him, we've got our dear leader tonight from ShareSite, the CEO of ShareSite, Doug Morris. And ShareSite is used by over 100,000 people worldwide to easily track their portfolios online. And then we've got Kylie Parker. Kylie is a director at Lotus Accountants. She has shared her life lessons in a book titled Planning Plan B: How to Prepare for 10 of Life's Unexpected Stressful Events. Only 10, Kylie. And is that the book that we're giving away tonight? Yes. Fantastic. Okay. And then at the end, we've got Ted Richards. He's the Director of Business Development at Robo-Advisors Six Park. He's a former AFL Premiership player with the Sydney Swans and a keen student of behavioural economics, which he recently studied at Harvard. And he also hosts the Richards Report podcast. So we're going to start with some questions. What is the most memorable investing mistake that you've made?
There's so many to pick from. I'd say that probably the most memorable investing mistake is the one that went to zero. It was right when I was starting out. I did very little research, bought something based on, I think it was an Intelligent Investor article about some sort of plantation timber company. So I bought shares in that, which was cheap, and not long after that it went to zero. I think that was the end of me not researching shares, and actually give me a good kick in the butt to really start researching and understanding the risks of what I was buying. So that's the most memorable, not because I lost the most money out of it, but because I lost all my money on it.
For me, similar story. It basically a case of me not doing my homework whatsoever and being an overly aggressive male in his mid-20s. During the global financial crisis, I saw some of the writing on the wall, as did a lot of us, about what was happening in the real estate markets, and in particular the commercial real estate market in the U.S. So I went looking for something that would give me short exposure to that. And so I looked around to try to find an ETF that did that. And there was a whole menu of really, really sexy and aggressive sounding ETFs, like ultra short bear, 2X ultra short bear, and of course I picked 3X ultra short bear because 3X is better than no X. And what I didn't do is read the prospectus or read anything about it, and so I put some money in, and kind of let it ride because I'm kind of a buy and hold guy. And I noticed that the only thing that it was doing when I was checking on it was just losing money slowly but surely. And I thought, how is this possible? I'm short a market that's just going down the tubes. Well, I didn't realize that the instrument reset itself every day. And so all I was doing was just paying fees to this particular ETF company and not checking in on my performance. So buyer beware was definitely my mistake.
Worst investing mistakes, 2 divorces. But apart from those, probably again going back to research. And so I do a lot on Twitter, a lot on social media, and so that's where I'll do a lot of my research these days. It's amazing sort of what you can track back by following the crumbs. And I was watching Simon Holmes-a-Court a lot on renewable energy, and so I made an investment in Infigen Energy, and it was only afterwards that I was aware that it was a rebranded Babcock & Brown investment. And so I'm still holding because it's at some point it's going to make money. But
I thought you were going to say social media was your worst investment. That's probably something I'm guilty of. Phil said I used to, my former life, I was a footballer. I got drafted when I was 17. I read a book about investing and I thought I was the shit, and put some money into the stock market. It was Pacific Brands because I'd seen Bonds undies everywhere, and I didn't do my due diligence and realised that Pacific Brands own a basket full of companies and Bonds is just this much, and a lot of those other companies are loss-making, and the investment went very poorly, even though my original thinking that Bonds was going all right was actually right. So, but lost a bit of money there, but it gave me a taste, and I guess over the last however many years, I'm just trying to get better each time.
Yeah. So what have you learnt, Ted, from the mistake?
I guess there's so much to learn. When I look back at myself at 17, I was something very guilty of what some people in the room may be aware of, called the Dunning-Kreuger bias, the Dunning-Kreuger effect, where we overestimate our ability when we don't have too much experience in that. And I guess that would be a mistake that I'm guilty of. But what I am fascinated by these days is the behavioural side of investing, because there's the logical, rational things that we'll touch on tonight, but there's also the way that we've evolved to make decisions which influence our decisions, and that which many of the room will be familiar with overconfidence, endowment effect, and all these things that can subconsciously influence your decision, and they're very powerful. It's how we've evolved. So you can't avoid them. You've just got to manage those to the best of your ability.
So it's all about the emotions as well, and the feelings that you can have for a company.
It can be. I think that a lot of mistakes do ultimately come down to some sort of emotional human failing. But if I've not picked a risk and I've looked past it, and if I've failed to avoid that for my readers, ultimately that's always a mistake for me. You can't avoid mistakes. A great mentor of mine once said, look, mate, we make mistakes in our lives every day. There's not a single day you don't make a mistake, whether it's big or small. So you do have to live with mistakes in a way. But, another great friend of mine said, look, just don't lose the lesson. So that's basically my message for tonight is, in most mistakes, or at least plenty of them, you can find a lesson, and don't lose the lesson.
It's become much easier to invest in a basket of stocks all at once via managed funds and ETFs. What should people look for in ETF, and what is an ETF, Ted?
Yes, this industry is just full of acronyms, and here's yet another. So exchange traded.
Make it clear for us.
An exchange traded fund, and there's all sorts of ETFs, from pure vanilla passive ETFs that just track an index, and there's also smart beta ETFs, which can have a bit more of an active tilt and a bit more of an active position. So I guess, where would you like to start with ETFs?
Well, I think let's go back to the basics. I mean, how many people are aware of ETFs here tonight? And do you understand how they work? The difference between active and passive? No? We've got a few shaking heads. Well, let's go for the basics between...
very simplistically, there's passive investing, which is investing in indexes, which the likes of Vanguard, iShares, State Street have become very popular through the benefits of investing passively. And in the other corner of this metaphorical boxing ring I've got, is Warren Buffett, who is, I guess, even though he loves passive investing, he is an active stock picker.
I love ETFs, even though I'm the CEO of ShareSite, which is predominantly aimed at people who run their own portfolios. We track ETFs too, of course. I love ETFs. I call it core satellite. I kind of have a bedrock of ETFs that I use to protect capital, and then I pick stocks that I like, that I've done my research on, that sort of are in the field that I work on. So it's a lot of technology stocks, it's a lot of software as a service stocks, things that I'm very familiar with and very comfortable in researching. So that's how I use ETFs, but I think they're great. And also, particularly in Australia, I remember when I moved to Australia 12 years ago, I got a bit of money back in a tax return from the States, and that was probably the money that I lost on that terrible commercial real estate play, also through an ETF, so buyer beware. I was looking around as to how to place my money in a managed fund, or what we would call a mutual fund. And so I went to, fidelity.com.au or whatever, and I was like, why can't I buy a managed fund? This is crazy. How do I actually invest in one? And you can't. The only way to invest in a managed fund, historically anyway, was through your superannuation or through an investment platform, which just have really, really high fees. So I was shocked. And so, again, ETFs are a great alternative to that. And it's still kind of the case, really. So,
Ted, please explain robo-advice to us.
Yeah, I guess through the Royal Commission, there's been many sad stories that have come out about what's been going on in parts of the banking world, and which includes financial advisors. And I do feel sorry for many financial advisors, because there are many fantastic financial advisors out there that have been providing great value for their clients that have, their industry has been tarnished. So I don't think anything's ever going to replace quality face-to-face advice that is transparent and no conflicts. What we provide at Six Park is a form of advice, and that's done online. So the term robo-advice is a bit of a misnomer, as unfortunately there's no robots or some sophisticated cyborg.
There's no algorithm in the background. There's real humans.
Yeah, there's real humans, and our investment committee includes people that have former Minister of Finance for the Australian government, former chairman of JP Morgan, and former co-CIO of the World Bank. So real people that are making important decisions for our clients. It's just that we don't take clients out for lunch. We won't buy you coffees and things like that. So, and with robo-advice, it's not holistic financial advice. So if clients, investors, people are looking for help with estate planning, setting up trusts, and property, that's not us, but we can help people get an investment portfolio and help them be invested in the market and look after them for them. Have you got anything to add there? Because I'm sure you probably work side by side with many financial advisors.
No, I probably haven't had a lot of good experience with financial planners, unfortunately. I think too many of them have been aligned with other banks or other bodies. So I think actually the best financial planners I've seen are the ones that do that holistic planning. They do a risk profile, they get the family members involved, they help with estate planning, insurance, cover a whole lot of the aspects of your financial plan in its entirety. And one person that I work with a lot at the moment, it's to me the mantra has always been wealth creation is the process of accumulation. And so it's just sometimes there's so many people that want that quick stock hit and to get a win, and they are, unfortunately, they're rarer. It's it's a little bit like gambling. And you do get a couple of those, and then you kind of chase them and you start missing the warning signs. And so it would still really be a case of the good financial planners I've seen are just, okay, let's start putting $25,000 away in self-managed super fund. By the time you get to 60, you're going to have a lot of money. You start that at 20. That's how you get rich.
Did you know that personal information, like addresses and phone numbers, is collected and sold by data brokers across the internet? Fortunately, Aura steps in scanning the web, sending you alerts, and requesting the removal of your info when found. Get a 14-day free trial of Aura's full toolkit, including ID theft protection, parental controls, and more at aura.com/safety. That's AURA.com/safety.
Okay, well, I want to ask everyone on the panel how their kids are invested and what you're teaching them about investing.
My kid's like 19 months, but the only thing he has is Google shares. And actually a lot of this talk about ETFs, it just keeps coming back to me to why not just buy Google shares? So Google is this amazingly powerful company that literally is a route to market for almost everybody. So it always has you by the balls. If you think of the stack of economics of just our commercial world, there are only a limited number of routes to market, and Google is like one of the major ones. And any business, Google can, businesses lose $40-50 million of their market cap when the Google algorithm changes. This is a company that can always tax everybody. You're literally buying a right to tax everything. So you're telling me that the ASX 200, with its mining companies and big four banks, are most of that index. That's not diversified. Are you joking? To me, Google is diversified. That's going to tax everything anyone does in the West. That is a diversified holding. I would take Google shares for my son any day over an ETF.
What about DuckDuckGo?
Ask Jeeves.
That is interesting because Google also has me by the balls because my wife has worked there for 12 years. So she's remunerated with Google shares. And also, half of our advertising budget at ShareSite is filtered through Google as well. So, yeah. We've been investing in some kind of blue chip shares, kind of along the lines of what Kylie has said for her kids, really. But again, it's very concentrated in areas that we know, so pretty tech heavy.
And have you started teaching her about anything, or?
I'm trying to.
Yep.
I'm trying.
How? In what sort of way?
We're just at the basics of kind of financial literacy at the moment. I mean, I'm trying to say why Daddy has to go to work, basically, so he can earn money to repair the paint that you just tore off the wall. So we're kind of at that stage.
Any plans though in the future?
Oh, certainly. Yeah, for sure. I think because that was one of those things. My dad worked in financial markets, and then I worked at Morningstar in a very boring but very academic area, and that really has paid dividends for me over the course of my career. Yeah.
I've got two boys, and 15 and 12, and then two stepdaughters. And so it's actually been interesting with the blending of the families as to kind of you don't realise if you do come from a background where you talk about money. Sometimes you don't feel like you're teaching kids, but it's just inherently going in. And so the stepdaughters, their level of financial awareness is on a steep upward slope right now. So I actually asked both my boys what, in terms of had I taught them anything in investing before coming along tonight. And my 15-year-old has reverted back to Nerf guns. So he was saving for quite a while. I think there's a natural tendency with kind of what we're born with in terms of how we spend. And so he was saving a lot, and now he's just blowing it all on Nerf guns at 15, which is just weird. So I don't know if I've taught him anything. Where my 12-year-old, though, is collecting coins. So at the moment, his biggest thing he wants is $1,000 to buy some big silver coin. And so not only does he, is he aware of one, it's got a value, but it's also then he knows he can go through all threepence, sixpence, tell me, what year, when they were created, all about the currency, who was on the back, what percentage metals. A lot of them are silver, I particularly like silver. And so I think actually from a young age, I would sort of thinking about this is just collecting something of value, not LOL dolls, but so how do you get them into, one, saving for something, and I do think travel is a really good thing for children as well. So I always had two places I wanted to take my kids, and that was Disneyland and Africa, and we've done both. And to me, that was sort of showing them the heights of capitalism, and then also, how fortunate they are. And that lesson in Africa didn't sink in at the time. They thought the kids there were pretty lucky. They weren't going to school and running around with knives. But I think as they've got older, they've got a bit more awareness of that. And again, just travelling also teaches different, politics, currency, and just the more diverse opportunities you can present to your kids, the more that they become aware of the value of money. Because I think I've got a lot of friends that have got kids in private schools and they've just had everything given to them, and clients as well. And some of them, they're just train wrecks. They're on drugs. The parents are supporting them. I've got clients that I will keep the kids because the kids cannot manage the money for themselves. So the parents will pass, and I'll just be helping the kids manage things. And that's not what you don't want to create wealth and then only to see your family, not be able to live their own independent, successful lives.
I've got 2 kids, 3 and 1, so not having the conversations with them as yet. But I guess if we are talking about creating wealth tonight, so much has been about how we can create wealth through investing. But one of the easiest ways to create wealth is to increase your savings rate. So I'll be having that conversation with my kids about the importance of, I love the line, it's not what you earn, it's what you burn. And coming from my former life as a footballer, did I see some guys on incredibly high salaries for 10, 15 years that led extravagant lives with their lifestyle creep, and by the end of their career, not much to show for it other than some pretty impressive photos of cars and boats that they owned. But the line that I love, that I really want to reiterate to my kids, I think it was Bill Gates that said it, and I think people need to maybe remember this when it comes to investing, is that we all overestimate what we can do in 1 year and underestimate what we can do in 10 years. So harnessing the power of compound returns when it comes to investing, whether you're active or you're passive or you've just got money in the bank, you don't really harness that real power until years, decades. So it's not about weeks and months. So I guess that there are some philosophies that I'll be telling my kids about.
Fantastic, thank you. Okay, I think we're going to open up for questions now from the audience. Has anyone got a question, please?
One of the first issues addressed was around your biggest mistakes. And I've certainly made some mistakes with buying shares as well. One of the difficulties I've had is really deciding when you're past that point where you've got to get out. And I'd be interested in hearing some opinions about how you really work out when it's time to get out.
Yeah, so I think for an actual stock market investor who's analysing and trying to buy and sell shares, the key is to make sure you understand, you have a thesis for what you think is going to happen when you go in. With the example I gave, the reason I took so long to do it is I wanted to explain to you my thesis going in and then how that didn't work out. And that's going to tell you when you've made a mistake ultimately. If you've made a series of predictions about how you think the actual business is going to go and you can just separate that out from the share price, if the share price is dropping, that's a clear sign to go and check your thesis. Is it broken or is it still true? And if you can see that what you thought was going to happen is no longer happening, then my general position is to say, okay, well, that's the time to get out. Now, it's always easy to open up to, but the share price has dropped now, so, if we just change the thesis a little bit and now it's still cheap again, but that's sort of known as thesis creep. And everyone, including professional investors, including myself, can end up doing this. And so for me, sort of the first thing to do once the thesis is broken is sort of even just sell it or sell most of it, and then you can sort of sit on the sidelines and see if you want to buy back in with the sort of new thesis. Things are different then.
But what sort of percentages would you be talking about doing? I think that's the point. What sort of percentage loss you would...
Yeah, so honestly, there's the ideal situation for me would be that something happens and there's no percentage loss, and I've spotted that the thesis is broken and I sell without any loss. Or even that the market, sometimes it does rarely happen that a business might announce an acquisition, for example, and the share prices actually go up. But when you go and research the company they're acquiring, it looks like really terrible and it looks like this acquisition is a bad idea. And you never had a thesis where they were going to make these acquisitions, and that would be enough to say, break the thesis. Generally speaking, it's very rare for a share price to fall, say, 50% without something really have changed, assuming that you're trying to do some valuation and buying things sensibly on the way in. If you're just buying random stocks like at the peak of their hype, then yeah, they can fall 50% for no reason. But if you're trying to buy things that are undervalued in the first place, usually if it's fallen like, even 40% or 30%, usually something's happened. And certainly if a stock has fallen 30%, and there's no obvious thing that's happened, I'm desperately looking to try and find what has happened and what is spooking the market.
For me, it's just about kind of discipline. It's basically writing down a thesis and then putting in some kind of KPIs in like a Google Keep note. That's what I do on my phone, so I can look at it and remind myself. So one that I'm living through right now and I've been holding on to too long is OzForex or OFX. And I'm still supportive of my thesis, but I've fallen into the trap where I just don't understand what's been going on. Anyway, competition, et cetera, et cetera. But it's kind of buoyed back up to around a loss of about 10% or so. So I think that's kind of a good trigger for me. 10% I can live with. It's probably time to get out.
Yeah, I was just going to add that the emotional side can really kick in. And so checklists is a common theme that has been brought up. Having an investment diary can be great. But the last one is holding a pre-mortem as opposed to a post-mortem, where before you buy the stock, you actually work out the ways that try and forecast the ways that it may not work out. And I think if you've ticked those three things, that might be give you a bit of remove your emotions and give you a bit more of a framework to make the decision.
I need to work out that myself. I'm so overweighted now in Xero. I bought in when it listed in Australia. And so I'm so emotionally attached, though, that... that wasn't a mistake. No, it wasn't a mistake. But that's the out bit. It's like, should I be sort of selling down some now? But I can't let go.
Thanks for the Google pick. Awesome. And my question is around, where is your go-to sources for investing in stocks to purchase? So thanks to the Warren Buffett, that's cool. But what sources do you guys look at to do your kind of investigation before you purchase something?
I would go first to the facts. Go to Morningstar.com for U.S. stocks or Morningstar.com.au for Aussie stocks. But yeah, or the primary source. Go to the company reports. Like, you need to get objective information on price history, financials, competitors, etc. As just to influence yourself as little as possible as to what others are thinking about that stock. So that's where I always start. If I'm doing anything trading-wise, I always have a tab, Bloomberg or something like that open. I mean, the free Bloomberg, not the expensive terminal, just to get the share prices and just factual information, really.
But how does that identify a particular stock?
Well, that's where I start. I want to start there just to kind of zoom way out, get a lot of context, and then go to the cufflinks, the live wires, the ethical investors, things like that. So
I'm actually looking at, so I did a whole ASX top 100, just check when I got remarried and my new husband wanted to put his money into my super fund as well, because he's now getting the benefit of my returns. I don't know if you have super funds work, but member fund balance, it's not an issue at all, obviously. But I actually did do a listing of the top 100, because there's actually, if you think about the money in super, that there's not a lot to invest in Australia. I mean, really, for what's there. So I did just go through the top 100 and I just website each of them, and I went and actually had a look on the boards. So I'm really about diversity, and I think that the more varying inputs that companies have these days, I think Atlassian, the way that that is run is something that is a testament to how the organisation can be so agile. So I go back to looking at boards. So sometimes I think women invest a little bit differently as well. And so, and I'm not a professional, investor. I've seen a lot of, I worked at a Dutch trading Optiva trading company for a while. And I've worked at Deloitte, I've worked at Xero, BBC. So I've kind of, I've got a good broad view of what's there. And I would say sometimes it's still about, do I like the company? Do I like what they do? Do I think they're doing good things? So sometimes it might be yes, then I might go to looking at newsletters, and Morningstar is one thing I would always use straight up. But I don't think it hurts to actually just looking at the ASX, looking at even just their brief bit of information on each one. Do you like the look of it? No, get out of it. Go to the next one.
Yeah, so I just wanted to double down on primary documents. I'm a big fan of encouraging everybody who's investing to actually read the annual report, look at the profit and loss statement, the cash flow statement. You will be able to find, if you don't understand that straight way through, you can start Googling questions. You can just ask Google anything and it's going to tell you an answer. So just look at the primary documents is the first step. Then when you're actually making decisions, something like a newsletter, like Ethical Equities, and there are others out there, is useful for finding someone to A, suggest to you what stocks you might want to look at yourself, and B, to help you sort of master the psychology of investing, to take you through the journey. We make mistakes too. We've got a recent article about, sharing mistakes that we've made as investors, and also successes as well. And then even down to the nitty gritty of how do you understand a cash flow statement? How do you calculate free cash flow? I think if you look at you must look at the primary documents at some point yourself. That's absolutely what I encourage people to do. And then secondly, you will start, it's an excellent point, you will start developing your own biases. And I think one of the advantages that people who may not be accountants can actually have is to start looking at the people that are involved in company and then looking at their track record. That can be a really powerful way to double check other ideas you might have read about a company. Personally, generally speaking, I just think the most valuable thing you can do is just read the annual report of the companies you own. I
can't help myself. I'd add one more thing. Just understand who's getting paid and how when you read stuff. Someone's always getting paid, except for primary sources.
Well, the annual reports may still be misleading in some way, but they are still they're still the primary document. The financials have been audited. 99% of the time, you can trust them.
Okay, I'm an accountant. I wouldn't read the financial statements. Only because I just, in terms of, there's no level of consistency. And I mean, I was actually talking to a senior lecturer at UTS, and she was running through some of the financial statements that are being prepared. And, MYOB would come out with these crazy statements of what they're doing, and you just go, I was out there in the field talking to accounting firms, and everyone is just getting off MYOB and going on to Xero. And this is back in the day. And I talked to fund managers, and they go, "Oh, MYOB's got this good return and everything." I was like, "Yeah, it's dying. It's like it's going to be dead."
If you sat MYOB next to MYOB next to Xero, that's an excellent example. You can you can look at which one's revenue's going up faster. Xero's going up a lot. Revenue for MYOB's not going up much at all. Yeah, MYOB had a greater profit. I never bought MYOB myself. I did buy Xero. And I looked at the accounts, and I could see in the accounts that one of them was growing quickly and one of them wasn't. And if you play that out in a few years, I'm not saying look at the profit and buy on a PE ratio. I'm saying look at the accounts to see the story.
My question is for Ted and for Kylie. Kylie, you mentioned just a moment ago that women tend to invest differently. And right at the beginning, Ted, you mentioned overconfidence being an issue. Can you both... I'd love to hear your opinions on how men and women tend to invest differently, both at the start, but also, longer term experienced investors who've been investing in markets for a number of years.
At Six Park, we're aware of the data analytics, and we can see who's logging in to their portfolio the most. So we actually get great feedback and once we split it up for male and female, and males typically, I forget the actual numbers, check their portfolio daily, are more likely to change their risk profile and time the market and do all these things which we know is incredibly hard to do, and females can be far more conservative, far more disciplined, but there is a negative to that too, and that is females are, in what we've seen, are far more likely to keep money in cash, and which is great over the short term, but over the long term, if you are conservative and keeping your money in cash, it can affect you. your ability to get longer returns over time. So that's what we've seen at Six Park. There is a material difference.
I'd agree, and I don't have the data to look at that. But I'd also, I think a lot of female clients I have tend to be more in properties as well. So I think that visual, again, they are more conservative. Does it hinder sort of some of the decision making that we do? I wouldn't say it does over the longer term. I suppose it's just, again, that risk profile. You can have generalisations about both sexes, and there are some women that are quite risk takers and do amazing things. I would say women, though, are now, because there's still a gender bias towards males, and so obviously there's lots of things around about addressing that, is that I think the more and more that rises in terms of diversity on boards as well. So I think I don't think a male would necessarily. A lot of men are now starting to support that diversity. I've got friends on boards at Mirvac, quite high levels, and across other industries, and obviously they've got a CEO who's a female. So it depends on their own structure as to whether they'll then start supporting that. I looked at something today, it was like 6 white guys, and I just went, I'm not going to invest in that. So I don't think a guy would look at that and go, I'm not going to invest in that for that reason. Like, it's just not, that to me is just a thing, and it's so big, where a guy would have to have it be, I don't know, a journey, I don't know. I don't want to speak on behalf of men, but it's not something that's as glaring to them as what it would be for us inherently.
Okay. Well, can we say thank you very much to our fantastic panel? Come on, up, take a bow. They've been fantastic, haven't they? And can we also say thank you to Finimize and to ShareSite for putting on this fantastic evening? And I think the pizzas will still be warm enough to eat.
Thank you. Finimize have a lot more events coming in Sydney, so if you're not already a Finimize subscriber, you should subscribe. And we're also hosting a lot more events at ShareSite.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any shares based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. And I'd also like to say a big thank you to Christopher Soulos of Garlic Breath Studios for all the fantastic help with the music production.
Did you know that personal information, like addresses and phone numbers, is collected and sold by data brokers across the internet? Fortunately, Aura steps in, scanning the web, sending you alerts, and requesting the removal of your info when found. Get a 14-day free trial of Aura's full toolkit, including ID theft protection, parental controls, and more at aura.com/safety. That's AURA.com/safety.